Forex trading is a challenging yet rewarding endeavor. Successful traders know that relying on a single indicator can lead to inaccurate signals and losses. Instead, combining multiple indicators that complement each other can improve decision-making and trading results. In this article, we'll explore some Forex trading indicators that work harmoniously and explain how they can be used together effectively. Likewise, at the end of this video, I'll show you a never-before-seen combination of not one, not three, but 5 indicator which give insanely accurate buy and sell signals on the XAUUSD pair, as you see here. So be sure to watch the video until the end. Plus, it would be greatly appreciated if you would hit that like and subscribe button, as it motivates us to make more valuable content for your benefit. Let's get into it. Forex indicators are mathematical calculations based on historical price, volume, or open interest data. They provide insights into market trends, momentum, and potential reversal points. While no single indicator guarantees success, combining different types can offer a clearer picture of market conditions.
No! God, please, no! 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 No!
Moving averages, trend indicator. Moving averages smooth out price data to help identify the direction of the trend. Simple moving average and exponential moving average. Combine a short-term moving average, example 10-period EMA, with a long-term moving average, example 50-period EMA. When the shorter EMA crosses above the longer EMA, it signals a potential uptrend, and vice versa for a downtrend. Relative Strength Index. RSI measures the speed and change of price movements to determine overbought or oversold conditions. How to use: RSI values range from 0 to 100, with levels above 70 indicating overbought conditions and below 30 indicating oversold conditions. Use RSI to confirm trends indicated by moving averages. For example, if moving averages suggest an uptrend and RSI is near 30, it may indicate a good buying opportunity. Bollinger Bands. Bollinger Bands measure market volatility and provide price boundaries. Moving Average Convergence Divergence. The Moving Average Convergence Divergence indicator helps identify trend direction and momentum. Look for MACD line crossovers and divergence from the price trend. For instance, if the MACD line crosses above the signal line and RSI confirms momentum, it's a strong buy signal. Fibonacci Retracement. Fibonacci retracement identifies potential support and resistance levels based on historical price movements. Plot Fibonacci levels on a significant price move. Use these levels with trend indicators like moving averages to identify key entry or exit points. For example, if the price retraces to the 61.8% level and RSI shows oversold conditions, it could indicate a strong buying opportunity. Combining the indicators. To maximize the effectiveness of these indicators, use them together strategically. Use moving averages and MACD to determine the overall trend direction. Avoid trading against the primary trend. Confirm oversold or overbought conditions using RSI and Bollinger Bands. Look for confluence with Fibonacci retracement levels. Monitor RSI and Bollinger Bands for signs of reversal. Use Fibonacci extensions to set profit targets. Use Bollinger Bands to gauge market volatility and adjust position sizes accordingly. Let's say you're analyzing XAUUSD. The 10-period EMA crosses above the 50-period EMA, indicating an uptrend. RSI is near 40, suggesting momentum is building for further upside. Price touches the lower Bollinger Band, hinting at a potential reversal. The price retraces to the 50% Fibonacci level, aligning with other indicators. Based on this analysis, you enter a long position with a stop loss below the 61.8% Fibonacci level and a take profit target at the next resistance level. Tips for using indicators together. Avoid overloading. Stick to 3-4 indicators to prevent conflicting signals. test your indicator combination on historical data to refine your approach. Indicators work best when used with fundamental analysis and proper risk management. Now that you've made it this far in the video, allow me to show you the indicator strategy that I promised you at the beginning of this video. The first 3 out of 5 are popular aforementioned indicators in previous videos, so if you haven't watched that video yet, I'll leave a link in the description to that video for you to watch after this one, so you can have a more comprehensive idea of how valuable adding the other 2 indicators is. For the sake of the new viewers, we'll take it from the top. The first indicator on the list is the 100 exponential moving average. A little side note, I'm not going to go too in-depth on either of the indicators, as I've already spoken about 3 of them. Plus, there will be future videos dedicated to reviewing each indicator individually, as I did with the MACD indicator in the previously posted video. Anyways, go ahead and add the 100 EMA to the chart with the settings you see on the screen. You can pause the video and manually copy the settings of each indicator onto your MetaTrader 4 or MetaTrader 5. Need to add is none other than the Ichimoku Kijun Sen. Once you add the Ichimoku, it's initially going to look like this. But we do not need all this, we only want one part. As such, we are going to hide all the components, except for the Kijun Sen, which is set to a period of 26. The third indicator is the stochastic, and it's vital to ensure that you copy the settings as you see here. This will make it more appealing to the eyes and less choppy. The last 2 indicators, the Commodity Channel Index, or CCI for short, and the William Percentage Range are 2 oscillators just like the stochastic. With the default settings, add them to the bottom of the chart, with the stochastic on top of each other as you can see. It doesn't matter the order. One of the beauties of this strategy is the fact that the time frame does not matter. But for demonstration purposes, I'll use the 1-minute time frame. As explained in the previous video, carefully observe the relationship between the Ichimoku and the EMA, as this indicates whether you should be looking for a buy or sell signal. You are in a buy market when the 26 Ichimoku Kijun Sen is above the 100 EMA, and a sell market is when the Ichimoku is below the EMA. The final part of the buy and sell conditions is fairly simple. Ensure that all 3 oscillators are in an overbought for a sell condition to be fully met. On the other hand, make sure that all the oscillators are in an oversold condition for the sell signal to be fully met. For clarity, the William Percentage Range has an overbought level of -20 and an oversold level of -80. The CCI has an oversold level of -100 and an overbought level of +100. The stochastic overbought and oversold levels are 80% and 20% respectively. So to summarize, a buy condition is fully met when the Kijun Sen is above the moving average and all 3 oscillators are in an oversold condition. A valid sell signal is when the Kijun Sen is below the moving average and all 3 oscillators are in overbought status. Once you enter a trade, you can either set a take profit for that specific trade, or break even said trade and let it run while using a trailing stop, preferably one that moves in steps rather than one that moves with each tick as prices go favorably in your direction. With this, you can enter more trades as more buy conditions are met, while each of the previous trades goes deeper in profit. You have 3 options to utilize as a close condition to ensure that your losses remain smaller than your wins. A small stop loss. In my case, since I'm using the 1-minute time frame, a fairly good stop loss would at about $2 to $3. Option 2. Close all buy trades when the Ichimoku crosses below the EMA. This means that the market is no longer in an uptrend, so it would be unwise to buy trades open at this point. Similarly, close all sell trades when the Ichimoku crosses above the EMA. So option 3. Close all buy trades when all 3 oscillators enter an overbought condition. This normally signals a retracement is incoming. On the other hand, close all sell trades when the oscillators are in an oversold condition. You can use either just one or all 3 together or mix it with your own exit strategy. Combining complementary Forex trading indicators is a proven way to enhance your trading strategy. By understanding their roles and using them cohesively, you can make more informed decisions and increase your chances of success in the Forex market. Remember, practice and consistency are key to mastering any trading approach. If you found this video helpful and want to learn more about mastering the Forex market, be sure to hit that subscribe button to join our community of aspiring traders. We release lots of valuable content like this, so don't miss out on any of it. Thank you for watching.